Welcome to this short executive knowledge lecture on Topic 7, Paper 7 of the SHC licensing exams. This topic covers applications in the financial sector. Well, there's three applications we're going to consider: corporate finance, asset management or fund management, and financial advising. I will emphasize the important points to help you understand the core material you need to know to sit the exams, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 7 Resources. As ever, I strongly recommend that you supplement this learning with question practice, and we have uploaded over 300 practice questions covering all 7 topics for Paper 7 on the Examinator.online platform. So we start with corporate finance. Now, in each of these sections, we're going to ask, what is the discipline? Why is it important? And the work that the professionals carry out in these areas. So 3 standard approaches. So first of all, what is corporate finance? Well, glibly, corporate finance is advising on listings, mergers, acquisitions, and everything wrapped around those procedures. If we look at the notes, we're told it's the application of a range of economic and financial principles to maximize overall value of a business. We're told it's an art more than a science, because valuation, which is an important element of it, is highly subjective. Financial solutions for companies are tailored to meet the individual company's specific strategic and financial needs. So the corporate financier works with the client companies. So why is this discipline important? Helps companies achieve their goals, major one, which is maximizing the wealth or overall value of the business. It's critical for financial security markets, which depend upon corporations' need for cash, and professionals work. And when we say corporations' need for cash, what are we talking about? Listing securities, raising funds for mergers, acquisitions, and operations. Professionals work with different companies to help them achieve the optimum financial solution for their particular needs. It's unlikely you're going to be examined on any of those points. It really is the application of them, and I'll say more of that a little later. The work of corporate finance professionals, what do they do? Here we go. They provide strategic and financial advice to corporations and to individuals in the corporations. They value companies, specific assets, or specific company securities. So as I said earlier, valuation is a large part of it. They help raise capital in the form of debt, equity, and hybrid combinations, convertible bonds, for example. They help with lending to companies, business and financial restructuring, and they, as I've alluded to earlier, they advise on merger and acquisition strategies. Now, to perform the work, they need knowledge in financial aspects, law, tax, and their knowledge should cover accounting and financial analysis, corporate and securities law, taxation, and they should have international experience. And the personal skills they should bring to the party: strategic problem solving, relationships and communication skills, negotiation skills, ability to operate under pressure. And their high order personal values should include competence, self-discipline, honesty, integrity, trust, and determination. Now, are you going to be examined on the material on that page? Unlikely. You may get a question asking you which one of the following does a corporate financier not get involved in, and a favorite point to put forward is trading securities for corporations. No, they're not traders, they're advisors in the areas of corporate finance. But I haven't seen a great deal of the material on that page pop up in questions. We move on to asset management, the world of fund managers, fund management. What is it? It's where assets are managed by investment professionals, the fund managers. The assets are managed funds, also known as collective or pooled investment funds. Managed funds include unit trusts, mutual funds, retirement, corporate funds, private equity funds. And these fund or asset managers invest pooled monies in assets such as equities, debt, securities, real estate, and or cash. Now, Hong Kong attracts fund managers for many reasons, and they like to examine this. So I would say this is the first list that, yes, highly likely to be a question on. So why do fund managers like to come to Hong Kong? Well, central location in Asia, clear and respected regulatory regime, SFC, HKMA, etc. Just an equitable legal system. Yes, we have it. It is in place and operating. English language, that's the business language in Hong Kong, and administration skills. Simple low tax system. Yep, low tax is seen as a benefit. A route to the mass market in mainland China has been the case, and hopefully it will continue to be so. A world-class communications system, internet, etc. Highly liquid stock market and a deep pool of professionals supporting the fund management industry, including lawyers, accountants, investment professionals. So I'd be aware of what's on that list. So why is asset management important? Well, individuals save money and they are put in often pension funds, unit trusts, and mutual funds. And it's the asset managers that decide how these funds are going to be looked after going forward. Fund managers can invest in a broad range of investments that individuals can. I think that should read cannot. Yeah, so fund managers have a broader range of investments than individuals can. Yes, that actually reads okay. Key benefits of managed funds: access to professional investment manager services and diversification. If you put your money into one fund, in many cases, your investments are automatically diversified. And the SFC, I would be aware of this. The SFC set standards on diversification in the code and unit trusts and mutual funds. That's covered extensively at paper 6, but just one mention of it here at paper 7. And the requirements in the code that we should be aware of with regard to reducing concentration risk and increasing diversification is that a fund is limited to holding 10% of total net assets in the securities of a single issuer. So that is maximum 10% of securities of one company, and that can be debt and equity. And a fund is limited to holding 10% of the ordinary shares of a single issuer. There's a subtle difference between those two. Be aware of the 10%. Benefits enjoyed by the asset management industry at the top of page 4. They include access to greater investment opportunities for a relatively modest investment. So that means as an investor, you're getting access to greater investment opportunities by going into a fund. Cost benefits, the fund managers enjoy economies of scale, which are passed on in volume discounts, etc. Technology, fund managers have greater access to sophisticated technology, helping them with the investment management process. Liquidity, most managed funds can process redemptions on a daily basis. Not all, but most. And for the exam, remember daily settlement. And convenience, fund managers deal with all aspects of investing, custody, administration, settlement, voting. You don't have to worry as an investor. So these are the benefits enjoyed, I would say, by investors from the investment management industry. The work of asset management professionals, fund managers, what do? Here we go. They develop asset allocation strategies. They analyze past, forecast future with regard to market performance. They analyze all publicly available information. They value the securities to decide whether or not they're a good buy or sell. Buying, selling large amounts of securities at the best prices, monitoring performance of and managing exposure to specific securities. Now, to perform the work, the individuals in the fund management industry need knowledge, financial knowledge, international financial knowledge, including microeconomic analysis, including global economic, political analysis. You often get economic graduates going into this business. Statistical quantitative analysis, so you get mathematicians in there. Accounting knowledge, financial analysis techniques, accountants are in there. Valuation of a wide variety of financial assets and finance and investment. Portfolio theory, the world of Markowitz and others. Personal skills, analytical skills, relationship, communication, teamwork, and your high order personal values should cover competence, self-discipline, honesty, integrity, and trust. We move on to the last of the three: financial advising. What is financial advising? Now, this is an industry that's been growing in Hong Kong regularly over the last few years. It's a process to help individuals identify and achieve their personal financial goals, and we'll come to goals in a moment, through a comprehensive financial plan. Financial advising, also known as financial planning, an ongoing process of relating a client's changing needs and financial position to the changing environment. Now, the financial products provide different risk-return combinations, and the financial planner should match the individual's strategies and actions to the client's goals. And these goals can include, now in the SFC manual, it says these are typical goals. So these are common goals. There are some goals which are way off the chart, but the way you should read these are the common typical goals of individuals. They want to enjoy a particular level of income or savings. That's both in employment, but also in retirement. Achieve a certain asset value or return on an asset. Their goal could be to save, invest within an acceptable risk level. So they don't want high risk investments, and that occurs the older you get. Achieve liquidity and flexibility needs. So if you need liquidity, for example, for school, education, medical needs, you need that liquidity so that you're not investing all your earnings. Maximize after-tax returns within acceptable risk levels. Now, I've seen questions covering these goals. It would be no more than one question in a paper 7 exam. And there's an element of interpretation, so use that as guidance. Why is financial advising important? Well, it's a structured process to help individuals and families meet their financial goals and objectives. Now, the accumulated savings of the baby boomer generation, so that's post-Second World War, these individuals are enjoying increased life longevity. We're living longer, and it's stipulated the demand for financial advisory services. Indeed, people are retiring and are facing 20 to 25 years of living off their savings, and that's posing quite a challenge to the financial advising industry. Increased international mobility, place more emphasis on international tax planning. Increased sophistication of investment products, and they have to be explained to individuals. Then we have two phases. Know these are examined. We have the wealth creation phase, and that helps clients accumulate savings for retirement while providing finance for all forms of family expenditure. So that is during your working life. You should be creating wealth, and that emphasizes the need for high growth investments, diversification, all those types of strategies. Whereas the wealth protection phase helps clients who are reaching or have reached retirement to live the lifestyle they are planned for. There you are protecting your investments. You will not want to take on anything that is high risk. You certainly won't be going into speculative futures trading. Now, those two phases can be examined in one of two ways. One, by just examining the terminology, the wealth creation, the wealth protection. But the second is giving you a scenario and a question. And they will give you details of someone that is relatively young and has some time to work. Then the investment strategy should relate to wealth creation. Whereas if the person whose background they outline with regard to retirement and stability, it's the wealth protection phase. And there you should not be recommending anything that is too risky. The work of financial advisors. Work involved includes establishing clients' current financial position. This is the sort of the fact file. Establishing client short, medium, long-term goals and objectives, which we've looked at briefly above. Preparing an investment strategy and risk recommendations to meet the client's objectives. Selection of investment insurance products that are relevant to the client. Presenting and implementing the investment plan, and ongoing monitoring and management of client investments and expectations. That list can appear in a question. So please be aware of the work of financial advisors. I would have to say at paper 7, topic 7, out of the 3 roles, it's the financial advisor that tends to have the most questions. Corporate finance, maybe 1. Asset management, 1 or 2. The remainder will be the financial advising. Anyway, I continue. Top of page 6. The work of financial advisors includes investment, or to perform the work, they have to be aware of investment theory and practice, including asset allocation, product knowledge, financial product selection, risk assessment, management of different types of risks faced by clients, securities, corporate and tax laws. Their personal skills, empathy, confidentiality, they should understand their client, confidentiality, communication skills, discretion when dealing with personal client issues, sensitivity when communicating good and bad news to the clients in times of market volatility. So financial advisors should try and hide their own personal need for earning fees. That's sometimes quite tricky. You won't get examined on that. Given the professional trust relationship between a financial advisor and his or her client, personal values, competence, self-discipline, honesty, integrity, and trust, loyalty, sensitivity, tolerance, and respect. And the ethical requirements for financial professionals, these have been put forward by a number of professional associations, include acting in the best interest of clients, avoiding conflict of interest, preserving client confidentiality, protecting and promoting market integrity, and honesty at all times. Finally, we come to the interdependence of the functions in financial markets, and this is just showing how these actors all interact. Financial advisors, they promote advice to the investors. The investors then need to invest money and need help from asset managers. And asset managers will invest in companies who require funding and assistance from corporate finance advisors. Okay, so topic 7 will have a number of questions in the exam. And as I say, the notes that are provided in the study manual and the notes that summary notes I've provided here, maybe 50% of the questions will come from the bullet points that you see. The other 50% will come from interpretation of this information with any scenarios that are provided to you in the exam question. So a knowledge of the different types of investment and what is suitable for wealth creation and what is suitable for wealth protection will be important. That brings us to the end of paper 7. 60 questions in the exam. You've got to get 42 correct. That means you can get 18 wrong, which is quite a buffer. And I would suggest, having studied all the material in these lectures, you should now go and do the question practice that you will find at Examinator.online. As I say, we have over 300 questions for paper 7. Good luck.